Hello, everyone, and welcome back to another episode. I'm your host, the Millennial Investor, and today what we're going to go over is we're just going to give a bunch of small updates to my portfolio. We're going to look at different companies like Waste Management, Broadcom, CocaCola, Lockheed Martin. There's a lot of different companies that we're going to go over. I have a bunch of small pieces of news. So in this video, we're going to give you some quick updates. So if you're following along with my strategy, if you own a lot of the same companies that I own, I currently own these 24 that I'm showing on the screen right now. And if you want to follow along with my investments, and if you already own these companies, these little pieces of news are important if you're an investor in them. So I'm going to go over all of these in this video. So if you're not familiar with me, if you're new to the channel, I track my annual and monthly dividend income through these two top charts right here. And then on these bottom two charts, I also track my portfolio value and my monthly YouTube income. So if we go back here to the M1 Finance tab, you can see that in my profile, I have a Refer and Earn tab. And this allows me to share my profile link so that way every time one of you guys download this link, you will now get $30. You heard me right. $30 just for getting signed up and depositing $100 to the platform. And one piece of quick news I also wanted to mention here is that M1 Finance is now getting their Plus system, their M1 Plus system, a 1-year free trial for M1 Plus, and that ends at the end of January. So if you haven't used M1 Finance before, now is the perfect time because back-to-back things are happening. Not only is the system free to use 100% of the time, but if you want their M1 Plus system, which comes with a lot of free features, for example, M1 Borrow, M1 Spend, 2 trading windows, and lots of other things as well. If you want access to all that, you can now do that for free in the month of January. And also getting signed up, like I said, you can get 30 bucks for doing it. And there's lots of other things to check out down below in my description as well, including mentoring calls, Yada savings accounts, credit card referrals, all that stuff. But let's go ahead and get into the first piece of news. What makes up 2% of my portfolio, if I scroll to the bottom here, we're going to go over a quick piece of news involving Waste Management. And I meant to mention this the other day, but I forgot to. It's been a while now, but they did just recently announce a dividend increase and a share buyback program. So Waste Management has an incredible business model that continually finds ways to return capital back to shareholders, whether that's growing revenues, growing profits, increased buybacks, or increasing that dividend payments. They find ways to make their shareholders more wealthy by the day, by the year. And you see that this dividend payment, it did get increased by about 5%. Waste Management said Monday that it plans to raise its quarterly dividend by more than 5% and refresh the authorization under its stock buyback program. The company's board has approved a plan to increase its dividend to 5.75 cents a share from 5.45 cents a share. This will raise its annual dividend to $2.30 a share to $2.18 a share, the company said. The company expects the new dividend will be payable March 2021. The company's board has also authorized a buyback program of up to $1.35 billion, superseding the authority remaining under its $1.5 billion stock buyback program in 2018. So not only is this company finding ways to increase revenues every year through their trash system and the network of clients that they have and their sticky revenues, and basically as we get more and more populated and more gross as a country, as we make more trash, Waste Management is going to be the ones behind us to clean it up. So if that's the case, if Waste Management has a sustainable business model, they will continue to do what they just announced the other day. They just raised their dividend more than 5%. They raised it from $2.18 up to $2.30, and they're now buying back more of their own shares. So that gives you more of a trading floor as well, because not only is the everyday public investing in this company, but the company itself is buying back its own stock. And we've seen companies like this, like another one that I recently announced that announced a huge stock buyback program of about $30 billion. It's up another 5% as well today. And you can just see in the last month, this company has been taking off. JP Morgan Chase has been buying back a lot of its own shares. And when you have companies that are profitable and actually has the money to make this happen, like Waste Management, for example, when the company buys back its own shares, you usually get great share price appreciation. So great news there for Waste Management investors, and I'm really excited for the future of this company. Next up, we have a piece of news that is for my number one investment. Let's go back here to M1 Finance and let's go to my portfolio. And if you see my number one investment in my portfolio, 9% of my net worth goes into this one company alone. We're looking at Broadcom. And I've mentioned many times, and I made many videos in the past, and it's having another good green day today as well. I believe actually that might be the all-time high where we're at right now. If not, it's just a couple dollars off. But this company has had some incredible performance here in 2020 and going into 2021. Broadcom, I love this company for so many reasons, not just as a dividend investor, but I love their business model and also some of their products as a consumer. But Broadcom just priced senior notes and they're aiming to boost their balance sheet. Broadcom recently announced the pricing of senior unsecured notes in 5 tranches of different maturities and carrying different interest rates as well. The company prices notes worth $750 million, having interest rate of 1.95% and maturity in 2028. Another 2.45% senior notes are due 2031 or $2.75 billion at a discounted price at 99.718%. Principal amount worth $1.75 billion, carrying 2.6% interest and maturity in 2033 is priced at 99%. Now, if we go ahead and look at this, their debt is being priced at roughly 2% interest rate. We know that the average inflation in the United States is roughly about 2% as well. So the way I look at it, when you factor in inflation and you factor in that this is a long-term debt standing, this is not any short-term notes that are due in 1 year or 2 years. These are due many, many, many years out. So if that's the case, Broadcom is getting some incredibly cheap debt at these levels. And I've mentioned this before because a lot of my other large corporations have done this as well. But Broadcom is now pricing some senior notes at some incredible values. If you're offering debt at 2% interest in the billions of dollars, you're probably going to be successful because they are raising their revenues and more importantly, their cash flows and net profits at much higher than 2%. Right now, they're raising both of those top line and bottom line metrics by roughly 8 to 10% a year. So much faster than the 2% debt that they just issued. So great news there for Broadcom. I think that is going to help them grow the company even a little bit faster. Next up, we have a company that has been hit very hard over the last week. And actually, the funny thing is, as I started filming this video, I just got an alert on my phone that actually fourth. So it says 3 cuts in a row, so 3 cuts in 3 days, why Wall Street is suddenly hating on Coca-Cola. It's actually had 4 downgrades. So this company has had some massive downgrades in the last couple of days, and it has been nothing but straight down over this past week or so. Going into the first week of January, Coca-Cola has had a horrible year to start 2021. Coke is falling almost 3% on Wednesday, following the stock's third downgrade in as many days, as analysts grapple with the beverage giant's future amid the uncertain timing of post-pandemic reopening. Deutsche Bank analyst Steve Powers cut his rating on Coca-Cola stock, ticker KO, to hold from buy, and lowered his price target to $55 from the original price target of $57. He writes that Coke continues to represent a compelling recovery narrative heading into 2021, especially given the weakening dollar, yet he notes that the pacing of broader recovery, and secondarily Coke's execution, has always carried some uncertainty. Coke gets a much greater portion of its business from away from home consumption at places ranging from restaurants to movie theaters than does rival PepsiCo, which I also own by the way, which also makes up 5% of my portfolio. But what makes the timing of a reopening all the more salient for the stock, this risk and people's ongoing hesitancy to resume their old ways even as vaccinations become more widespread, also has been cited in other recent downgrades of the stock. And if we scroll down here, we'll look at other downgrades like Guggenheim and RBC Capital Markets have already downgraded Coke on Monday and Tuesday. The firm saw ongoing headwinds stemming from the pandemic, which may weigh on Coke's business longer than bulls expect. The latter also concurrently cut its Pepsi, which also received another downgrade today. So a lot of people are hating on Coke recently because they think that the valuation is a little bit overvalued. They think that this company is not what it used to be. And I will agree that the company has faced some headwinds here going into 2021 and in the last 5 years or so as well. But when I look at this company, I see an incredible track record. I see a company that is renovating its products, changing some of its franchising business to improve that bottom line, and also looking to expand into some new areas as well, like Topo Chico brands and AHA sparkling water. It's changing some of its brand up and also changing some things like Coca-Cola with coffee. It is finding new ways to increase revenues and bring some more brand recognition to the company. So Coca-Cola, while it's definitely getting some hate recently, this is one that I'm absolutely sticking with for the long term. And as an investor, as it goes lower, I'll just be buying more and more of the company. And as now it has a dividend yield that is over 3%, well over 3%, I will be buying this company as it goes down heavier and heavier. So if it goes down to 45, I'm still buying it. If it goes down to 40, I'm still buying it as long as the fundamental business still stays the same. And as a side note here, it does have an incredible track record of raising its dividend. And as you can see here, it paid out 35 cents a share in dividends, up to 37, up to 39, to 40, to 41. And as you can see, they raise that dividend in March of every year. And guess what's about to happen? We're about to get another dividend raise in about a month or so. So not only will this be paying a 3.21% dividend yield today, it will also be raising that dividend any time now. Now, I don't expect it to be very large, probably just a penny, up to 42 cents if I were to guess. But regardless, no matter how big, no matter how small, any dividend raise is appreciated as a dividend growth investor, as well as an incredible yield. So Coca-Cola, I'm excited about that one for the long run. Next up, let's go to the company that is most recent in my portfolio. Made a lot of talk about it recently in a lot of my videos. We're talking about Lockheed Martin. And this company has a bright future ahead of it, in my opinion. And this just reinforces that theory, okay? Because when I look at articles like this, it seems like every day this company is landing new contracts in the hundreds of millions or tens of billions of dollars. This company is getting massive contracts, what seems like every single week. And this is no exception. Yesterday, this article was posted that Space Force awards Lockheed Martin $4.9 billion for missile warning satellites. Now, if we scroll down here and we read this first two little paragraphs of the article, it says Lockheed Martin secured $4.9 billion to build 3 missile warning satellites for the U.S. Space Force, according to the January 4th announcement. The company had already received $2.9 billion in 2018 to begin work on the satellites, which will be part of the next generation overhead present infrared system. The contract covered development through critical design review completed in October 2020. With that step finished, the program was ready to move forward with manufacturing the satellites. So what's really cool here is that not only do they have some very credible customers, which is very important to our government and some of the clients that they have, but this company is getting contracts that are so expensive that the profitability is ridiculous. While it will cost a lot of time and research and effort to produce some of these resources that these companies and that these governments need, when you're getting contracts that are roughly $5 billion in revenue, it's pretty easy to say that a lot of this will end up going to the bottom line and end up producing a lot of value to the shareholders. So now that we're seeing a lot of people getting scared about a Democratic president, and this company's been trending down ever since, as we see, what is that, since August, September, pretty much on a straight line down ever since then, this is getting more and more exciting as an investor that I can now buy this company at a 3+% dividend yield. They just raised their dividend as well, about 10% from $2.40 a share up to $2.60. And I believe that raises the streak. I can't remember off the top of my head. I think it's 19 years in a row. But this just once again just reinforces my positivity about Lockheed Martin and gets me a little bit more excited about the stock. Now let's go to last but not least. This isn't an individual company. I'll just search SPY here so I can pull up the market. And this is a little freaky. It's a little bit scary to see this. And I know as people get more wealthy, as inflation goes up, I know this is standard. I know that this is normal. But it's just kind of crazy to see these numbers. Margin debt reaches new all-time high. Margin balances have reached a new record high as widening class of affluent Americans borrowed against their portfolio investments to buy more stock. Margin debt has reached the highest point in 2 years as investors borrowed a record $722.1 billion against their investment portfolios through November, topping the previous high of $668.9 billion from May 2018. Now, the previous high was set in May of 2018. It wasn't back in early 2020 before the crash happened early back here. But now going back into early 2021, where we are today, we are now breaking well past that previous number. Not even close. We're break the previous record by what's that, like 54 billion, something like that? And when you see these numbers, it's really scary to see because people are starting to get over leveraged. They're betting that this bull market will never end. And even as you see today, guess what we have today? Another new all-time high. How much are we up today? Another 1.5%. This is the entire market, by the way. So when you're seeing the market go up 1.5%, you're talking about hundreds of billions of dollars. So when you see these types of moves up, it's really scary as an investor. I think people are starting to get very euphoric. And the good news is a lot of the companies that I own are not incredibly overvalued. I pick a lot of safe, stable dividend companies, so I don't think their valuations are too out of reach like a lot of these other high growth tech companies are. But when you see numbers like this, it is pretty scary as an investor. And I just want to tell you guys, make sure you keep level-headed out there and keep your portfolio sharp. But that's going to wrap it up for this video, guys. Thank you for watching all the way to the end. I just wanted to give a quick update with some of the companies that I own. And like I said, free M1 Plus for a year if you haven't signed up already. And $30, the highest it's ever been. No longer $10 to get signed up. Not $20 like some of the promotions we've had in the past, but $30. You get $30 for signing up and depositing $100 to the platform. But thank you guys so much for watching, and I'll catch you guys next time.